part 6 in our financial statement analysis series, and here we'll be discussing the calculating of financial statement ratios and using those ratios to determine the financial health of a company by comparing a company's ratios with that company's industry ratios. So the first one we'll look at is what's called working capital. Working capital simply measures the amount of current assets that we would have left after paying off all of our current debt. So to measure that, or to calculate working capital, we would take our current liabilities and subtract those from our current assets. Another ratio that's widely used is called the current ratio. This measures a company's ability to pay its current liabilities with its current assets. To calculate this ratio, we take our current assets and divide that by our current liabilities. A rule of thumb is a current ratio of about 1.5. But again, it's relative, depending on what industry the company you're looking at is in. So a good industry average for one industry could be 1.2, not 1.5. So if a company's current ratio is anywhere now around 1.2, then they're probably okay. So what that 1.2, or the rule of thumb 1.5, tells us is that for every $1 of current debt, we have $1.50 in current assets to cover that dollar of debt. And the last one that we'll look at here is the acid test or quick ratio. This is, does a company have the ability to pay all of its current debt if it came due immediately? So there's a few current assets that we leave out of this equation that we included in the current ratio equation. So in calculating our numerator, we're simply going to use cash, our short-term investments, and our net current receivables, and divide that by our total current liabilities. That will give us our quick ratio. So let's take an example and calculate a current ratio and a quick ratio. So here are some data for you to use. And what I'd like for you to do is press pause on your player here at this point and see if you can use this information to calculate this company's current ratio and their quick ratio. And then come back and we'll compare our answers. Okay, so hopefully you have calculated the current ratio and the quick ratio using this data. So the first one is the current ratio. So you recall from our discussion that the current ratio uses total current assets divided by total current liabilities. So our total current assets here is $175,000, and we're going to divide that by our total current liabilities of $131,000. That gives us a current ratio of 1.3. So again, that's slightly lower than our rule of thumb of 1.5. But it could be perfectly fine for this company depending on the industry average. So again, what this tells us is that for every $1 of debt, current liabilities, we have $1.30 in current assets to cover that $1 in debt, current debt. And you never want to rely on just one financial ratio. So we'll compute the acid test ratio. So recall this one is slightly altered, an altered version of the current ratio. In the numerator, we're only going to use cash, short-term investments, and net receivables, and then divide that by total current liabilities. So in this case, we get an acid test ratio or quick ratio of 0.63. This tells us for every $1 in current debt, if it came due today, we only have 63 cents in current assets to cover that $1 in current liabilities. So a good rule of thumb for an acid test ratio or quick ratio is at least 1. So this company doesn't look like it's faring very well. So you'd probably want to compute some more financial ratios and definitely do some industry research to find out if the industry as a whole is doing poorly.